Good morning, students. I hope you all are doing well and able to understand what you are going through. As I said, I earlier didn't receive any of the mails from you, and I hope I will receive soon. So here we are seeing our chapter number 3, that is recording transactions. Now, what are the transactions that you know, the event that are occurred in business, like purchase, sales, expenses, income, that are transactions, how they are recorded, right? So here is a topic that is accounting equation. Accounting equation, what does accounting equation mean? Right? Take example in maths also you have certain equations, right? Plus two numbers are added, then we are getting a combined number in a plus form, right? Number increases. If something is subtracted, so the number of that particular number decreases. So that is equation. In the same way, accounts also has certain equations. Accounting equation signifies that the assets of a business are always equal to the total of its liability. Please underline that line. See, total of the assets of business are always equal to the total of its liability and capital. That is owner's equity, like capital. You can see in this over here. This is A. A stands for asset. L stands for liability, C stands for capital. I am revising it again. What is a assets? That is your land and building, that your cash, that your bank balance, then your shares that you had invested, then your what we say machineries and your any other things, right? That all are assets. The amount that you are going to receive in future, everything is your asset. Now, what is liability? The amount that you have to pay in future, like loans, the amount paying to the creditors, then any kind of what we say amount withdrawn from the business, that is drawings and anything, right? These are certain forms of liabilities. Remember current liability, non-current liabilities, right? That are your liabilities. And capital, what is capital? When an owner starts the business with the investment, that investment is the liability of the business. That investment is the liability of the business. So that's why it is cash, capital plus liability equals to asset. Remember this. What is asset? Liability plus capital. That is your asset. The above equation can also be presented in the form as its derivatives to enable determination of missing figures of capital or liabilities. That is A. If you want to know what is the capital, so what you are going to see, assets minus liabilities, so that gives you capital. Is it clear? See, if you want to know capital, so you are going to take this L to this side, so that goes to minus basic equation of maths. So asset minus liabilities gives you capital. And if you want to know the liability, so asset minus capital gives you liability. Is it clear? I hope you are clear with this. Since the accounting equation depicts the fundamental relation among the components of balance sheet, these are the parts of balance sheet, students, right? So it is called balance sheet equation. This is called balance sheet equation. See, I'm just explaining you what is balance sheet. Now this is the format of your balance sheet. Over here, I'm writing roughly. This is liability side. Liability side. It is written as liabilities. I'm writing in short form. and this is asset. This is asset. This is the amount column of asset. Here amount is written, here amount is written. I'm using the sign. So here amount, assets and liabilities. Always remember the total of both. It is a statement and it is termed as balance sheet. The total of both the sides of balance sheet is always same. Double tick means it's always same. So here we write over here there is capital and the rest of the thing is goes to liabilities. Is it clear? So this, wait, capital plus liability, that gives you this assets. Is it clear? Format will be again shown to you. And always remember the total of the balance sheet is always same. At any point of the time, resources of the business entity must be equal to the claims of those who have financed these resources. The proprietors and outsiders provide resources of the business. The claim of proprietors is called capital and that of outsider is known as liability. As I had shown you, you can see the double ticks are there. So the topmost is the capital and from that other part is the liabilities to whom we have to pay. Insider is your owner, that is the capital giver, and then that is liabilities. Each element of the equation is a part of balance sheet which states financial position of the business of a particular date. When we always analyze the transaction, we actually try to know what the balance sheet of the business entity gets affected. Asset side of Asset side of the balance sheet is the list of assets. As I earlier explained you, land and building, machinery, all that are assets, current asset, debtors, cash, bank balance and all that, right? The liability side of the balance sheet is the list of owners, claims, outsiders, that would be what is the business entity owns. The equality of the asset side and the liability side of the balance sheet is undeniable fact. This justifies the name of accounting equation of balance sheet. For example, Rohit started. As you can see over here, there is a format of balance sheet. Books of Rohit balance sheet as on every year it is written on 1st April of the year to 31st March of the ending year. Right. So you can see over here it is a liability. Liabilities is written, then amount, assets and amount. Here capital is there 5 lakhs. So obviously cash in hand is 5 lakhs. It justifies it. Capital, suppose he has invested cash. Let us see the example. We started business with a capital of 5 lakhs. From the accounting point of view, the resources of the business entity is in the form of cash. 5 lakhs sources of the business entity. Contribution by the Rohit is capital is 5 lakhs. So that cash also is available to him is 5 lakhs. So it is balanced. See, I had said you both the sides of balance sheet is always same. You can see over here. Double tick is total is same. In the same way, whatever is added over here, it will be balanced over here. If it is added over here, it is balanced over here. Right? In the above balance sheet, the total assets are equal to the liabilities of the business since the business has not yet started. In activities and has not earned any profits, the amount invested in the business is still 5 lakhs. In case of any profits earned, it will increase the invested amount in the business. On the other hand, if business suffers any losses, it decreases the invested amount. We will now analyze the transaction listed in example 1 and it breaks down different elements and you will observe the accounting equation always. Opened a bank account in the State Bank of India with an amount of 4,80,000. Analysis of transaction. This transaction increases the cash balance, assets increases and decreases the cash. That is asset by the 4,80,000. Furniture of 60,000 and check was issued on the same day. Right. Furniture of rupees 60,000. So furniture comes in. So the balance of asset as a fixed asset increases, but the bank balance decreases because the payment of transaction is done by check. The transaction increases the furniture asset and decreases the bank asset by 60,000. Bought plant and machinery for business for 1,25,000 and advance of 10,000 is paid in cash to Ramji Lal. See, 1,25,000 is machinery is brought. So 1,25,000 your machinery is increased. But 10,000 cash balance decreases and 1,15,000 the left amount goes to the liability side. You can see over here. So that is the balance justifies. Goods purchased from MS Sumit Traders for 55,000 analysis. The transaction increases goods asset. Okay. Goods purchased from the stock increases, that is goods increases, and liability because you are going to pay in future, so that is a creditor, liability also increases. Goods costing 25,000 sold to Rajni Enterprise 35,000. See, when it is sold, the name of the organization or a firm or a person is given, it's a credit transaction. That's why there is a liability. If cash is paid, so cash would have decreased. Is it clear? So 25,000 goods goes out, so stock decreases and debtors increases. And profit is there of 10,000, that also profit increases. You can see over here. Outsiders claim is 1,70,000, cash 10,000, bank 4,20,000, debtors 35,000, stock 30,000, furniture 60,000, plant and machinery 1,25,000. And creditors is 1,70,000, buy capital 5,10,000, that is 680 and 680 balance is same. Using debit and credit. As already stated, every transaction involves gives and takes aspects. In double entry accounting, where the transaction affects the and is recorded in at least two counts, when recording each transaction, the total amount debited must equal to the total amount of credited. Always remember, whatever is debited, that particular entry, the amount of the credit side would also be same. If credit side is having that amount, so debit side would also have the same, right? So, when recording each transaction, the total amount debited must equal to the total amount credited in the accounting terms. Debit and credit indicate whether the transactions are to be recorded on the left hand side or right hand side. Debit means on the left hand side and credit means on the right hand side. In its simplest form, an account looks like a T, better T, because of its shape. This simple form is called T account. Notice that T format has left side and the right side for recording, increase in decrease in the at the end of the accounting period. For example, if it is an account of a customer, all goods sold appear on the left debit side of the customer's account and all payment received on the right hand side. The difference between the total of two sides called balance shall reflect the amount due to the customer's inner P account. The left side is called debit, the right hand side is called credit. You can see the format if it is given. can see over here. Debit side and credit side. Don't go over that one. It will just confuse you. You can follow over here only. This side of account is debit side. This side of the account is credit side. The rules of debit and credit. All accounts are divided into 5 categories, that is asset, liability, capital, expenses or losses, and incomes and gains or revenues and gains. As you had said, I had said in the beginning only, assets, liabilities, expenses and losses, incomes and gains. Two fundamental rules are followed to record the changes in this account. For recording changes in assets and expenses, increase in asset is debited and decrease in asset is credited. Obviously, when something is added in your stock, take example, you have one vehicle and you are purchasing one more vehicle, so that your asset is increases, so it is debited, and when it is removed, so it is credited. Increase in expenses is debited and decrease in expenses is credited, right? So two things, assets and expenses are debited when they are increased, and when they are decreased they are credited. You follow this rule. Again, I am repeating, assets and expenses, when they are increased, they are debited. And when they are decreased, they are credited. For recording the change in liability, increase in liability is credited and decrease in liability is debited. Right? In the same way, increase in capital is credited because liability is written on credit side. Right? That's why. And decrease in liability is debited. Increase in revenue is credited and decrease in revenue is also is debited. So you have to remember this, right? The rules applicable to different kinds of accounts have been summarized in the following way. Right? Assets, increase in asset debit, decrease in asset credit. Increase in uh, expenses debit and decrease is credit. In the same way, three things are together. That is, when capital is increased, it is returned on credit side. In the same way, when revenue is increased at the time, it is returned on credit side. When the what we say liability is increased, it is returned on credit side. Expenses we had seen decreased debit side, debit side, right? So now you can see over here there are certain transactions, analysis of transaction. The transaction increases cash on one hand and then increases on the other hand, liabilities increase. See, cash account 5 lakh. Rohit started business with a cash of rupees 5 lakh. So cash account on debit side 5 lakhs and capital account on credit side 5 lakhs. Right?